What if I told you there's this massive, multi-trillion-dollar investment universe that never, ever shows up on your stock ticker? Well, it's called private credit, and it's been quietly booming, kind of right under our noses. So let's break this thing down.
To even wrap your head around that number, think about this. Analysts are projecting this market could hit $5 trillion by 2029. That's bigger than the entire economy of Japan. So yeah, this isn't some tiny niche corner of finance. It's a colossal force that is only getting bigger.
So how in the world can a market this huge operate almost in secret? Well, it's because it exists entirely beyond the bright lights of the public stock market. You've got to think of it as a parallel financial universe, one that plays by a whole different set of rules.
Right. So while the news obsesses over every little tick of the Dow Jones, this enormous world is running on handshakes and direct deals. Companies that need money are connecting straight with specialized lenders, completely sidestepping the public stock and bond markets that you and I hear about every single day.
Okay, so what is private credit really? Let's get down to the brass tacks.
At its core, the definition is super simple. It's just lending to companies by folks who aren't traditional banks. But the story of why it even exists is actually pretty fascinating. See, after the 2008 financial crisis, new regulations came in that forced banks to get way more conservative with their lending. And that created this massive funding gap. And you know what? These private funds swooped right in to fill it.
And this right here, this gets to the heart of why the market just exploded. For a company that needs a loan, private lenders are like speedboats compared to the slow-moving battleships of the big banks. They're faster, they're way more flexible, and they can literally build a custom deal from the ground up to fit a company's exact needs.
And this isn't some one-trick pony either. Private credit covers a whole spectrum. You've got direct lending with senior loans, which means you're first in line to get paid back, so safer. Then you have stuff like junior capital, which gets paid back later but often comes with a shot at a much bigger reward. For an investor, it means you can actually choose your own adventure and pick your level of risk.
Okay, so we've got the what, but how does the money actually move around? Let's follow the trail, from the investor's wallet all the way to the final profits. The structure is actually pretty straightforward when you break it down. You have the investors, they're called limited partners, or LPs, and they're the ones who provide all the cash. And then you have the fund manager, or general partner, and their whole job is to find the right companies to lend that cash to. Simple enough, right?
Now, once those loans start making money, there's a very specific set of rules for who gets paid and in what order. It's called the distribution waterfall, and it's a pretty clever system that's really designed to protect the investor.
It might look a little complicated, but the core idea is incredibly simple. Investors get paid first. Period. First, you get all of your initial investment back. Then, you get a minimum guaranteed profit, often somewhere around 8%. It's only after the investors have hit that target that the fund manager starts to get their big piece of the action. This structure really aligns everybody's interests. The manager doesn't get rich unless the investors do first.
Now, for decades, this was a world that was pretty much exclusively for giant institutions. Think massive pension funds. But the gates to that fortress, they are starting to creak open, and that's changing absolutely everything.
What we're seeing now is a real push from regulators to democratize finance. The whole goal is to open up these private investment opportunities so they're not just for the Harvards of the world, but for everyday investors too.
And hey, this isn't just some wishful thinking. This is a direct quote from the SEC chairman. It signals a real policy shift. They see that a ton of the economy's growth is happening in these private markets, and they're trying to find safe ways for more people to get a piece of that action.
And the momentum here is just undeniable. This market is projected to nearly double in just 6 years. We're talking $1.5 trillion in 2022 to almost $3 trillion by 2028. And that explosive growth, it's not just coming from the big guys anymore. It's being fueled more and more by individual investors. So if you're an individual investor thinking, okay, this sounds interesting, but how would I even get in? Well, there are a couple of key vehicles that were basically designed to be the on-ramps into this world.
The two main on-ramps you're going to hear about are something called business development companies, or BDCs for short, and interval funds. Their entire purpose is to take these complex, normally hard-to-access private loans and package them into something that the average person can actually invest in. Okay, so the key differences really come down to rules and risk. BDCs are a bit more focused. They mostly have to invest in U.S. companies, and they can use more debt to try and juice their returns, which also, of course, adds more risk. Interval funds have more flexibility, but for an investor, the biggest difference is probably liquidity, as in how easily can you get your money out. Interval funds have a set schedule for buybacks, while with BDCs it's a little less predictable.
So, what does all this mean? We're really seeing a fundamental shift in how people think about building a portfolio. Let's just zoom out for the big picture.
So what's the big appeal? Why are people so interested? Well, it's a pretty powerful combination. You get potentially higher yields. That's what they call an illiquidity premium. It's a trade-off. You're basically getting paid a little extra for your patience, for not being able to sell your investment in a split second. And crucially, because these things aren't traded every day, they can give you a bit of a shield from the wild mood swings of the stock market. That is a really compelling mix.
The big takeaway here really is that those old, rigid walls between public markets, where anyone can invest, and private markets, which were once this exclusive club, well, those walls are coming down. And that is fundamentally changing the entire menu of opportunities available to everyone.
And all of this leaves us with one final thought. As this multi-trillion-dollar world becomes easier and easier to access, the question for every investor is no longer just what to invest in, but also where. So, will your next big opportunity be found on a stock exchange or somewhere else entirely?